Listen, I need you to pay very close attention to what I'm about to share with you, because what's unfolding right now in the gold and silver markets is something most people won't see coming until it's too late. And by then, the opportunity will have passed them by completely. You know what's fascinating? Right now, as I'm recording this, there are two completely different realities playing out simultaneously. There's the reality that most people see when they check their phones, scroll through financial news, or listen to mainstream analysts. And then there's the reality that's actually happening behind the scenes, in the vaults, in the trading pits, in the central bank boardrooms, where the real decisions are being made. Let me paint you a picture of what I mean. Just recently, the COMEX reported something that should have made headlines everywhere, but barely got a mention. Their registered gold inventory, the gold that's actually available for delivery, dropped to levels we haven't seen in years. We're talking about a decline of over 30% in just a few months. Now, you might be thinking, okay, inventories fluctuate. That's normal market behavior. But here's what makes this different. At the exact same time this is happening, we're seeing record demand for physical delivery. Not paper contracts, not ETF shares, actual physical metal that people want in their hands, the kind of demand that empties vaults. And when you combine falling inventory with rising delivery requests, you create something that every commodities trader fears: a squeeze. But let me take you back for a moment, because understanding where we are requires understanding how we got here. Think back to 1971. Nixon closes the gold window, ends the Bretton Woods system, and suddenly the dollar isn't backed by anything except faith and the full credit of the U.S. government. For a while that worked. The petrodollar system kept demand for dollars high. Countries needed dollars to buy oil, so they kept buying treasury bonds, and the whole system hummed along. But something's changed. And it's not just one thing. It's a cascade of events that are all pointing in the same direction. China and Russia have been accumulating gold for years now, not just buying it, but building entire systems around it. The Shanghai Gold Exchange, which most Western investors barely pay attention to, is now moving more physical gold than London in some months. Think about that. The center of gravity in the gold market is literally shifting from west to east, and it's happening in plain sight. And it's not just China and Russia. Central banks globally added over 1,000 tons of gold to their reserves last year. That's the second highest annual purchase on record. These aren't retail investors making emotional decisions. These are the most sophisticated financial institutions in the world, the ones with access to information and analysis that you and I will never see, and they're buying gold like their future depends on it, because maybe it does. Here's what keeps me up at night. The derivatives market for gold is absolutely massive. We're talking about hundreds of billions of dollars in paper gold contracts, all built on the assumption that only a tiny fraction of those contracts will ever demand physical delivery. It's like a bank that operates knowing that not all depositors will show up asking for their money at the same time. The system works until suddenly it doesn't, and we're starting to see cracks. There have been multiple instances recently where the spread between paper gold prices and physical gold prices has widened significantly. In some markets, you're paying a substantial premium to get actual metal versus just owning a contract. That spread, that premium, is telling you something. It's telling you that people are starting to question whether paper promises are as good as the real thing. Now let me tell you about something that happened in the silver market that should serve as a warning for what could happen in gold. Back in the early 80s, the Hunt brothers tried to corner the silver market. They accumulated massive positions, took delivery of physical metal, and for a while, it worked. Silver prices skyrocketed. But then, the exchanges changed the rules. They went to liquidation-only trading, meaning you could sell, but you couldn't buy. The Hunt brothers were forced to liquidate, and the price collapsed. But here's the thing. That was two individuals. What happens when it's not two brothers from Texas, but entire nations? What happens when it's China, Russia, India, and a dozen other countries all deciding they want physical metal instead of paper promises? You can't just change the rules and force sovereign nations to liquidate. That's a completely different game, and the signs are everywhere if you know where to look. The BRICS nations are openly discussing alternatives to the dollar for international trade. They're talking about a gold-backed trade currency. Now, whether that actually happens or not is almost beside the point. The fact that they're talking about it, the fact that it's even on the table, tells you that the unquestioned dominance of the dollar is being questioned. Let me share something with you that I find absolutely fascinating. If you look at the gold to silver ratio right now, it's telling you a story. Historically, that ratio has averaged somewhere around 60 to 1, meaning it takes 60 ounces of silver to buy 1 ounce of gold. But we've seen that ratio spike to 80, 90, even over 100 at times. Right now, it's elevated, which means either gold is overvalued relative to silver or silver is undervalued relative to gold. But here's what makes this interesting. Silver isn't just a monetary metal anymore. It's an industrial metal. It's in your phone, your computer, your solar panels, your electric vehicles. The green energy transition that governments around the world are pushing requires massive amounts of silver. And unlike gold, which mostly just sits in vaults, silver gets consumed. It gets used up in industrial applications, and it's often not economical to recover it. So you've got this situation where industrial demand for silver is rising, investment demand is rising, and above-ground stockpiles are falling. The U.S. used to have billions of ounces of silver in strategic reserves. That's gone. Sold off decades ago. There's no strategic silver reserve to tap into if there's a shortage. And speaking of shortages, let me tell you what's happening in the mining industry. The easy gold and silver has already been found and mined. The ore grades are declining. It takes more energy, more capital, more time to extract the same amount of metal. And with energy costs rising, with environmental regulations getting stricter, with permitting processes taking longer, the supply side of this equation is getting tighter. I was looking at data from some of the major mining companies, and their production is flat or declining. They're not finding major new deposits. The last big gold rush was decades ago, and it takes 7 to 10 years from discovery to production for a new mine. So even if they found a massive deposit tomorrow, it wouldn't hit the market until the early 2030s. Meanwhile, demand is accelerating. You've got central banks buying, you've got wealthy individuals in Asia buying, you've got institutional investors who are starting to wake up to the fact that maybe, just maybe, holding some gold and silver makes sense in a world where governments are printing money at unprecedented rates. And that brings me to something that I think is absolutely critical to understand: the money supply. The amount of dollars in circulation has exploded over the past few years. We've seen trillions created out of thin air to fund stimulus programs, to buy bonds, to keep the financial system liquid, and every single one of those dollars dilutes the value of every other dollar in existence. Now, the official inflation numbers will tell you that inflation is under control, that it's coming down, that everything's fine, but if you actually buy groceries, if you pay rent, if you fill up your gas tank, you know that's not the whole story. The real cost of living for most people has gone up significantly, and it's not coming back down. And this is where gold and silver have historically played a role. They're not investments in the traditional sense. They don't pay dividends. They don't generate cash flow. But they're stores of value. They're insurance against currency debasement. And in a world where every major central bank is debasing their currency, that insurance is looking more valuable by the day. Let me tell you about something that happened in Weimar Germany that I think is instructive. During the hyperinflation of the early 20s, people who held paper marks saw their savings evaporate. A lifetime of work, gone. But people who held gold, who held real assets, they preserved their wealth. They could still buy food, still pay rent, still survive. The gold didn't make them rich, but it kept them from being destroyed. Now, I'm not saying we're headed for Weimar-style hyperinflation, but I am saying that the dynamics that lead to currency crises are present. Massive debt, political dysfunction, loss of confidence in institutions, geopolitical tensions. These are the ingredients that throughout history have led to monetary upheaval. And here's something that doesn't get talked about enough: the derivative exposure of major banks to precious metals. These banks have massive short positions in gold and silver futures. They're essentially betting that prices will stay low or go down. But what happens if they're wrong? What happens if prices spike and they have to cover those positions? We got a glimpse of this during the silver squeeze a few years ago. Retail investors coordinated to buy physical silver and silver futures, trying to force a short squeeze. And for a brief moment, it worked. Premiums on physical silver exploded. Some dealers ran out of inventory. The price spiked. But then the momentum faded, the coordination broke down, and prices came back down. But imagine if that wasn't retail investors. Imagine if it was sovereign wealth funds, central banks, major institutions, all deciding at the same time that they want physical metal. The market simply couldn't handle that kind of demand. There isn't enough physical metal available at current prices to satisfy that level of buying. And this is where the price spike comes in. Because markets don't move in straight lines, they move in fits and starts. They can stay irrational longer than you can stay solvent, as the saying goes. But when they move, when the dam breaks, they move fast. I've been watching the technical charts, and there are some interesting patterns forming. Gold has been consolidating in a range, building energy. Silver has been even more compressed. And historically, when you see this kind of consolidation after a major move, it's often followed by another leg up. But the technicals are just one piece of the puzzle. The fundamentals are what really matter, and the fundamentals are screaming that something has to give. You can't have unlimited money printing without consequences. You can't have falling supply and rising demand without higher prices. You can't have a loss of confidence in fiat currencies without a flight to hard assets. Now, I want to talk about something that's relevant for a lot of people watching this. If you've built up retirement savings, if you have money in a 401k or an IRA, you've probably got most of it in stocks and bonds. And that's what financial advisors tell you to do. Diversify across different asset classes, rebalance periodically, and you'll be fine. But here's the question. Are stocks and bonds really diversified? They're both paper assets. They're both denominated in dollars. They're both subject to the same systemic risks. If confidence in the dollar falls, if the financial system faces another crisis, both stocks and bonds could get hit at the same time. And that's where physical gold comes in. It's not correlated to stocks and bonds. It's not someone else's liability. It's not dependent on the financial system functioning properly. It's just metal. Real, tangible, physical metal that's been valued for thousands of years. Quick aside here, because I think this is important. If you're sitting on a substantial amount in retirement accounts, there's actually a way to get physical gold into those accounts without triggering taxes or penalties. It's called a gold IRA, and I put together a free guide that explains exactly how it works. It's in the description below. Covers the process, the rules, what to watch out for. Worth checking out if that's something you're interested in. Anyway, back to what's happening in the markets right now. Because there's another piece of this puzzle that I haven't mentioned yet, and it's potentially the most important one. The dollar's role as the global reserve currency. For decades, the dollar has been the currency that everyone uses for international trade. If Japan wants to buy oil from Saudi Arabia, they do it in dollars. If Brazil wants to buy machinery from Germany, they do it in dollars. This creates constant demand for dollars, which allows the U.S. to run massive trade deficits and print money without immediate consequences. But that system is under stress. Countries are starting to trade in their own currencies. China and Russia are settling trade in yuan and rubles. India is buying Russian oil in rupees. The Saudis are talking about accepting yuan for oil. Each of these developments chips away at dollar dominance. And if the dollar loses its reserve currency status, even partially, the implications are enormous. All those dollars that are held overseas that are used for trade, they could come flooding back to the U.S. That's inflation on a scale we haven't seen in generations. Now, this won't happen overnight. These are long-term trends that play out over years and decades. But the direction is clear, and smart money is positioning for this shift. They're buying gold, they're buying silver, they're buying real assets that will hold value regardless of what happens to paper currencies. Let me tell you about what happened in 2008, because I think there are parallels to today. Leading up to the financial crisis, everything seemed fine. Housing prices were going up, the stock market was hitting new highs, unemployment was low, and then suddenly, it all fell apart. Bear Stearns collapsed. Lehman Brothers went bankrupt. The entire financial system was on the brink. And what happened to gold? It initially dropped as people scrambled for cash. But then it took off. It went from around $800 an ounce to over $1,900 an ounce in just a few years. People who owned gold before the crisis preserved their wealth. People who bought during the crisis made substantial gains. But here's what's different now. In 2008, central banks had tools. They could cut interest rates. They could implement quantitative easing. They could flood the system with liquidity. And it worked, sort of. It prevented a complete collapse, though it created other problems down the line. But now, interest rates are already low. Central bank balance sheets are already bloated. Government debt levels are already at historic highs. If there's another crisis, another shock to the system, the playbook that worked in 2008 might not work this time. They might have to get even more creative, print even more money, take even more extreme measures, and every one of those measures devalues the currency. Every one of those measures makes hard assets more valuable. I want to talk about silver specifically for a moment because I think it's the most underappreciated opportunity in the precious metals space. Silver has this unique characteristic where it's both a monetary metal and an industrial metal, and that creates interesting dynamics. On the monetary side, silver has been used as money for longer than gold. The word for money in many languages is the same as the word for silver. It's more accessible than gold for average people. You can buy an ounce of silver for around $25 to $30. You can't buy an ounce of gold for that. On the industrial side, silver is indispensable. It's the best conductor of electricity. It's used in electronics, in solar panels, in medical applications, in water purification. And as technology advances, as the green energy transition accelerates, industrial demand for silver is going to increase. But here's the kicker. There's not that much silver above ground. All the silver ever mined in human history, if you put it in one place, would fit in a cube about 55 meters on each side. That's it. And a significant portion of that has been consumed in industrial applications and is effectively gone. Compare that to gold. All the gold ever mined would fit in a cube about 22 meters on each side. But almost all of that gold still exists. It's in vaults, in jewelry, in coins. It doesn't get consumed. So the above-ground supply of gold keeps growing, while the above-ground supply of silver is actually shrinking when you account for industrial consumption. And yet, silver is trading at a fraction of its all-time high. Gold is near its all-time high. Silver is nowhere close. That disconnect can't last forever. Either gold comes down or silver catches up. And given everything else that's happening in the world, I think it's more likely that silver catches up. Now, let me address something that skeptics always bring up. They say gold and silver are barbarous relics. They say they have no place in a modern financial system. They say you can't eat gold, you can't pay your bills with silver. So what's the point? And on one level, they're right. Gold and silver don't produce anything. They just sit there. But that's actually the point. They sit there and maintain value while everything else fluctuates. They're the anchor in a storm. They're the insurance policy you hope you never need but are glad you have when disaster strikes. Think about it this way. If I told you that there was an asset that had maintained its purchasing power for thousands of years, that had survived the fall of empires, the collapse of currencies, wars, depressions, and every other crisis humanity has faced, would you want to own some of that asset? That's what gold and silver are. An ounce of gold in Roman times could buy a fine toga and sandals. An ounce of gold today can buy a nice suit and shoes. The purchasing power has remained remarkably stable over millennia. Can you say the same about any paper currency? The dollar has lost over 95% of its purchasing power since the Federal Reserve was created. The British pound has lost even more. Every fiat currency in history has eventually gone to zero. And we're living through a period where the pressures on fiat currencies are intensifying. Government debt is exploding. Entitlement programs are underfunded. Demographics are working against us with aging populations and shrinking workforces. Political polarization makes it hard to address these issues. And the easy solution, the one that politicians always choose, is to print more money and hope the problems go away. But the problems don't go away. They just get bigger. And eventually, the bill comes due. I've been studying monetary history for years, and there's a pattern that repeats over and over. Governments start out with sound money, usually backed by gold or silver. Then they face a crisis, a war, a depression, something that requires more spending than they can raise through taxes. So they start debasing the currency. They reduce the gold content of coins. They print more paper money than they have gold to back it. And for a while it works. The economy gets a boost. People feel wealthier. But then reality sets in. Prices start rising. People lose confidence in the currency. They start demanding gold and silver instead of paper. And the government has a choice. They can either restore sound money, which is painful and requires austerity, or they can keep printing and hope they can manage the decline. Most governments choose to keep printing, and that's when you get currency crises, hyperinflation, and the destruction of savings. We're not there yet. The dollar is still the global reserve currency. The U.S. economy is still the largest in the world. But the trajectory is concerning, and the smart move is to prepare before the crisis hits, not after. Let me tell you about a conversation I had with a financial advisor recently. He told me that gold and silver are too volatile. that they're not suitable for conservative investors, that you should only allocate a small percentage of your portfolio to them, if anything at all. And I asked him, compared to what? Compared to stocks that can drop 50% in a matter of months? Compared to bonds that lose value when interest rates rise? Compared to real estate that can crash when credit tightens? Everything is volatile. The question is, what kind of volatility are you willing to accept? Gold and silver might fluctuate in price, but they can't go to zero. They have intrinsic value. They've been valued for thousands of years and will continue to be valued. Can you say the same about a tech stock? Can you say the same about a government bond from a country drowning in debt? The real risk isn't owning gold and silver. The real risk is not owning them when the system breaks down. And I want to be clear about something. I'm not saying sell everything and buy gold and silver. I'm not saying the world is ending tomorrow. What I am saying is that the risks are elevated, the warning signs are flashing, and having some exposure to physical precious metals is a prudent move. Think of it as insurance. You don't buy homeowners insurance because you think your house is going to burn down. You buy it because if it does burn down, you want to be protected. Same principle applies here. You don't buy gold and silver because you're certain the financial system is going to collapse. You buy them because if it does, you want to have something that will hold value. And here's the thing about insurance. It's cheapest before you need it. Once the crisis hits, once everyone realizes they need protection, the price goes up. We saw this during the pandemic. When lockdowns started, when people got scared, the premiums on physical gold and silver exploded. Dealers ran out of inventory. Wait times stretched to weeks or months, and prices were significantly higher than the spot price. Right now, premiums are relatively normal. You can buy physical metal close to spot price. Inventory is available. But that could change quickly if there's another shock to the system. So what's the bottom line here? What am I actually saying? I'm saying that we're in a unique moment in history. The monetary system that's been in place since 1971 is showing serious signs of stress. Central banks are trapped. Governments are trapped. They can't raise interest rates without crashing the economy. They can't stop printing money without defaulting on their debts. They're stuck. And when systems get stuck, when there's no good way out, that's when things break. That's when you get dislocations, crises, and opportunities for those who are prepared. Gold and silver are how you prepare. They're how you protect yourself from currency debasement, from financial system instability, from the consequences of decades of bad policy decisions. The price spike I'm warning you about isn't just speculation. It's the logical outcome of supply and demand fundamentals that are getting tighter by the day. It's the result of central banks buying at record levels. It's the consequence of falling inventories and rising delivery demands. It's what happens when paper markets collide with physical reality. And when it happens, it's going to happen fast. You won't have time to research, to compare dealers, to figure out the best way to buy. You'll be competing with everyone else who suddenly realized they need protection. So this is your warning. This is your chance to act before the crowd does, to position yourself before the spike, to get insurance before the house catches fire. Because once it starts, once the momentum builds, once the squeeze is on, it'll be too late. The opportunity will have passed, and you'll be left watching from the sidelines, wishing you had acted when you had the chance. The choice is yours, but the clock is ticking.